edition of the Market Review for this day, 24th of July, 2020. Let's give you a lineup of what we'll be discussing this morning. Review of market performance, corporate announcements, updates from the Debt Management Office, ProShare Research Memo to AMCON, Coronation Capital and the Nigeria FX market, updates from the European stocks. Those are what we'll be looking at throughout today. First, let's begin with yesterday's performance at Nigeria Stock Exchange. Investors gained 176.71 billion naira as NSE ASI inched up by 1.40% amid flat market breadth. Equities market closed yesterday on a positive note as the NSE ASI appreciated by plus 1.40% to close at 24,512.27 basis points, as against 0.00% flat position recorded previously. Its year-to-date returns currently stands at minus 8.68%. Market breadth closed at as the Dangote Cement Company led 11 gainers as against 11 losers, topped by Neimet Pharmaceuticals. At the end of yesterday's session, it showed an unimproved performance when compared with previous outlook. For market turnover, it closed negative as volume moved down by minus 59.20%. as against plus 32.37% uptick recorded in the previous session. FBN Holdings, Custodian Insurance, and Zenith Bank were the active in terms of boosting the market turnover. Dangote Cement and MTN Nigeria topped the market value list. Airtel Africa led the list of active stocks that recorded impressive volume spike at the end of yesterday's session. The three big players in the markets showing what their value is: Dangote Cement, MTN, and Airtel Africa. Let's get on to some corporate announcements. Cadbury Nigeria PLC released its second quarter 2020 unaudited financial results for the period ended June 30th, 2020. Here are the key highlights. Revenue declined by minus 18.2% to 15.9 billion naira from 19.5 billion naira in the previous quarter. Profit before tax declined by 19.9% to 767 million naira. Profit after tax declined by 19.9% to 537 million naira. Net assets also declined by minus 2.8% from 13.6 billion to 13.2 billion naira. Let's give you updates from the Debt Management Office. It has to tell us that the auction result for the 12.50% FGN January 2026 reopening 10-year bond, the 12.50% FGN March 2035 reopening 15-year bond, 9.80% FGN July 2045 new issue for 25-year bond, and 12.98% FGN March 2050 reopening year bond had shown successful bids. Also, the bids are successful for 12.5% FGN January 2026, 12.5% I would say FGN March 2025, 9.80% FGN July 2045, and 12.98% FGN March 2050 were allotted at the marginal rates of 6 million, 9.5%, 9.8%, and 9.95% respectively. However, the original coupon rates of 12.5% for the 12.5% Federal Government of Nigeria January 2026, 12.5% for the 12.5% FGN March 2035, and the 12.98% for the 12.98% FGN March 2050 will be maintained, while the coupon rates for the 9.8% FGN July 2045 is set at 9.8%. Coronation Capital had published an article, very interesting one, on ProShare, talking about the parallel FX market. Let's just get updates from this very interesting piece. It said last week marked the point at which the Naira in the parallel market traded at more than 20% lower than the NAFEX market. Until last week, the difference had been less, but it was at 470 Naira to the dollar, measures and a 21.1% difference from the NAFEX rate at 388 Naira to a dollar. Whereas a monetary authority can, in their view, tolerate a difference of up to 20%, it becomes more difficult to ignore when it is greater than that. Traders and manufacturers buy US dollars for purchases of traded goods and raw materials and often source them from the NAFEX market, also known as importers and export window, as well as the interbank FX market. The problem with this, according to Coronation Capital, is that this market does not live up to its name, the Nigerian Autonomous Foreign Exchange Market. It is not truly autonomous because the Central Bank of Nigeria usually provides a backstop of US dollar liquidity, sometimes providing hundreds of millions of US dollars per month. That is until recently. Since March turnover on the NAFEX market, Coronation Capital notes that it has slumped as the Central Bank of Nigeria has husbanded its previous US dollar reserves. So where has the demand for the US dollars gone? Coronation Capital is asking. It would normally go the parallel market or street market. Back in early 2017, when the interbank FX market, quoted on Bloomberg, was 316 naira to a dollar, the parallel market rate was 500 naira to a dollar. That was a 58.2% difference. Yet, the pressure on the parallel market rate in 2020 has been slow to arrive and so far appears to be moderate. If the normal volume of US dollar demand were to appear in the parallel market, from Coronation Capital's perspective, we would expect a bigger adjustment than this. The World Bank's and IMF's forecast for Nigeria's GDP in 2020 are negative 3.2% and negative 5.4%, respectively. Given that the recession in 2016 was negative 1.6%, this implies a very significant slowdown at the moment. And given that they expect agriculture, 22% of the GDP, and telecoms, 10.9% of the economy, not to suffer much, this implies that the trade sector, 16.1% of the economy, and the manufacturing sector, 9.7% of the economy, are currently losing around 20% of the activity. This likely explains the lack of demand for the US dollars overall. However, as the trade and manufacturing sectors themselves adjust to the easing of lockdown restrictions, and as they take on new stock and attempt to pass on their foreign exchange costs to customers, Coronation Capital expects demand for US dollars to rise, though not actually to recover to levels seen earlier in the year. This suggests that there will be a further pressure on the parallel market's exchange rate over the coming weeks and months. Looking at the model equity portfolio, Coronation Capital says last week the model equity portfolio rose by 0.92% compared with the fall in the Nigeria Stock Exchange All-Share Index of 0.08%, therefore outperforming it by 100 basis points. Year to date, it has lost 4.47% against a loss of 9.52% in the NSE-ASI, outperforming it by 504 basis points. Coronation Capital's underweight notional position in the banks fared well last week as there was some profit-taking in the sector, so it avoided some downside. The strategy to reduce banks' exposure, which it has done by reducing the share of the portfolio from a neutral weight, 19.8% to 12.9% during the week of 22nd June to 26 June, has saved up 24 basis points so far. However, given the fundamental value in the sector, this strategy may be worth reviewing in future. Coronation Capital says it built up a neutral position in LT Africa last week, that this brings the positions in three large components of the NSE-ASI, namely Dangote Cement, Boa Cement, and LT Africa, to close to their neutral weights in the index. Coronation Capital also says it has a significant overweight position in other large components of the Nigeria Stock Exchange All-Share Index, MTN Nigeria, at 28.0% against an index weight of 19.2%. This, according to it, because it believes it will benefit from continued growth in the telecom sector in general and data usage in particular, and its valuation does not appear stretched. Coronation Capital also has combined position of the 5.5% in the palm oil and rubber producers Presco and Okomo. At the currency in the parallel markets adjust, which fell by 1.1% last week, the ability to earn a US dollar-rated commodity price becomes more interesting in his view. For the week ahead, it does not plan any purchase or sales, doesn't see any purchase or sales really happening this period. That's from Coronation Capital, interesting insight. Let's get on to Cornerstone Insurance. It's in line with its Rule 19.2A of the issuers' rules relating to board meetings and general meetings of issuers. Cornerstone Insurance PLC is informing esteemed stakeholders, the Nigerian Stock Exchange, and the general public that its board meeting of the company will be held on July 22nd, and that was just recently. The following resolutions were duly considered and approved from that meeting. the unaudited financial statements for the second quarter ended June 30th, 2020. Also, the transfer of 1,718 million from the company's share premium account to the share capital account by issuing bonus shares in the proportion of 7 new shares of 50 kobo each for every 30 existing shares of 50 kobo each to achieve the company's recapitalization plan. Don't forget NICOM, the regulator, and its recapitalization plan for insurance companies. Also, the issuance of bonus shares to shareholders of the company, subject to approval of the shareholders at the annual general meeting of the company. The board also approved the unaudited financial statement for the 2020 second quarter, which will be filed with the Nigerian Stock Exchange and Securities Exchange on or before 30th of July 2020 and published to the general public. That's from Cornerstone Insurance. Very interesting developments there. Now to a very, very insightful article, a memo from ProShare. ProShare has been writing extensively on market developments and the economy and bringing the attention of regulators. It's not a new thing to us. We've written a memo on the Nigerian capital markets several years ago, over 7, 8 years ago, on how the Securities Exchange Commission and the whole ecosystem should evolve. And again, here we are, writing a memo to the Asset Management Corporation of Nigeria, AMCON. So let's get on to it. Recent statements by Central Bank of Nigeria's Asset Resolution Company, AMCON, and in particular the Managing Director on the matter in regards to the likelihood of public sector resources being used to clean up 5 trillion in toxic banking sector loan assets. It says analysts have noted that AMCON's conjecture may have been propped by a mistaken premise. Specifically, the article refers to the pronouncement documented in the Point NG news story titled "Nigerian Taxpayers May Bear Burden of Unrecovered 5 trillion naira Debts." That's a warning from AMCON on the Point NG news story of July 19, 2020. Coming after that release of the May 13, 2020 Debtors Africa, which of course ProShare published and analyzed that report on debtors and non-performing loans in banks and the extensive work done thereafter, it was another example of misinformation that needed to be addressed, especially one from the regulator. The resolution company created in 2010 at the height of the asset delinquency challenge faced by banks at the time raised 1.7 trillion naira by way of a bond issue to the CBN to buy off toxic assets from banks and re-inject fresh funds to support system liquidity and protect depositors' liabilities. The arithmetic of the current situation suggests that so far AMCON has recovered 1.1 trillion naira, which represents 65% of the amount committed by the company to the protection of the domestic deposit liabilities and system liquidity or stability. The 5 trillion naira alluded to by Mr. Ahmad Kuru, the incumbent chief executive of AMCON, refers to the face value of the toxic loans outstanding. A number of clarifications needs to be set, and this is what the memo is providing now. First is that AMCON is obliged to recover the money that is raised from the Central Bank of Nigeria by way of bond, and therefore is required to recover the 1.7 trillion naira. Second, the face value of outstanding toxic loans is being written down by a banking sector sinking fund designed to pay off the bad loans from a deduction of 0.5% of the system total assets. Not immediately verifiable data suggests that the sinking fund was 139.13 billion naira in 2017, 154.98 billion naira in 2018, and 167.90 billion naira in 2019. Third, no supposed sunset clause will wind up AMCON in 10 years or by 2020, as presumed in the reported AMCON statement on the use of public funds to recover 5 trillion naira of delinquent loans. The initial 10-year target was based on the assumption of an average growth rate of total bank assets of 15% annually at the time annual bank asset growth was about 22%. In the event that banking sector asset growth slowed down, the resolution company itself life became annually or naturally extended. More recently, bank-wide asset growth had been between 5 and 6%. Loan recovery is less complicated than it may appear at first. Only 350 Nigerians are responsible for 80% of the 5 trillion naira in toxic assets outstanding. Let me just repeat that again. Only 350 Nigerians are responsible for 80% of the 5 trillion naira in toxic assets outstanding. The narrow spread of the delinquent borrowers means that AMCON recovery efforts should stay focused on the recovery of 4 trillion naira in toxic asset face value. A recovery of 70% of this amount should be seen as a clear win, as even the best recovery rates of bad loans in countries like Malaysia, which is around 58%. A noticeable proportion of toxic assets have been recovered by way of seizure of landed property, machinery and buildings. But the problem is that in an environment of low liquidity and slow economic growth, monetizing these recovered assets has become a high hurdle. At its inception, AMCON identified 10 banks with system credit challenges and subsequently injected 736 billion naira liquidity to buy up the toxic assets. With the structured repayment plan under a sinking fund arrangement, the suggestion here is that public funds will need to cover for the indebtedness of the banking sector, and having that perspective is very odd. The evidence available indicates that with expansion in bank-wide total assets as the economy picks up, it will lead to accretions to the sinking fund, which in turn would write off toxic assets size over time. Furthermore, the growth in the domestic economy would increase asset values and make the local investment market more attractive, resulting in fresh funds flowing into the real estate business as foreign direct investors buy into the economy in search of superior market yields, enabling AMCON to sell off stranded assets at tidy profits, thereby paying down the 5 trillion naira delinquent loans on the resolution company's balance sheets. Understanding the state of play, the pro-share memo says, since its inception, AMCON has acquired over 12,000 non-performing loans worth 3.7 trillion naira from 22 commercial banks and injected over 22 trillion naira as a financial accommodation to 10 banks. AMCON has been able to recover over 1.1 trillion naira, while its total obligation to the Central Bank of Nigeria was over 5 trillion naira. In a recent presentation by Mr. Aliyu Kalgo on behalf of AMCON's MD, Mr. Mitkuru, Kalgo noted that AMCON was unable to recover its outstanding debt of over 5 trillion naira and noted that the debt burden will become the debt of the federal government and local taxpayers. The statement, though well-meaning, wrongly interprets the financial accommodation principle guiding the establishment of AMCON. The financial accommodation meant that AMCON was to recover what it paid for toxic loans. The bank's sinking funds were expected to pay for the majority of the liability of the banks. The difference between the bank's loan purchase amounts and the balance with AMCON was referred to as financial accommodation. Therefore, financial accommodation was not AMCON's responsibility to recover, but that of the banking system through a sinking fund. According to this guiding principle of its establishment, the taxpayers should not be a party in the debt recovery process. Major parties to credit recovery include AMCON itself, the Central Bank of Nigeria, deposit money banks, credit bureaus, the Nigerian Deposit Insurance Corporation, and delinquent debtors. Therefore, recoveries by AMCON, note financial analysts, cannot be used as a fiscal cushion to help plug budgetary gaps of the federal government, and neither should the debt burdens resulting from an inability to recover toxic loans be shifted to taxpayers. Therefore, Proshe says, as far as corporate finance professionals are concerned, AMCON at no time had the legal right or fiscal responsibility to give the federal government money for whatever purpose, neither does it have the right to transfer burdens of debt. A gray area that is yet to be properly clarified is the role of the Nigerian Deposit Insurance Corporation. NDIC was saddled with the role of charging insurance premiums on deposits of distressed institutions. The insurance premiums charged were supposed to insulate debt depositors' funds in the case of the collapse of a bank. Therefore, NDIC's role was faulted, as there was no reason for NDIC to collect insurance premiums during bank failures when AMCON was covering the cost. But the NDIC has collected premiums from banks which were beneficiaries of AMCON intervention, meaning that AMCON was paying money to the federal government, to NDIC. According to the erstwhile managing director of AMCON, Mr. Mustafa Chikobi, if the adjustments for NDIC payments to the federal government by way of premium payments on deposits are added to the tax paid to the government by more now profitable banks, the money made available to the federal government by AMCON would be in the tune of 2 trillion naira. Mr. Mustafa Chikobi also clarifies the role of AMCON in debt recoveries. According to him, as the inaugural chief executive of AMCON, he gave his alternative view, which appears to contrast that of his current predecessor. He says all AMCON needs to do is to recover what it paid for the loans. The recovery of the balance of the face value of the loans outstanding on the asset resolution company's book was to be amortized and recovered by a sinking fund created for the industry's toxic assets. The bank's loans purchased amount was about 1.7 trillion naira. The balance of 4 trillion naira was what AMCON called financial accommodation. The accommodation was supposed to be paid back by the sinking fund and represents what the banks at the time had lost. Based on this playbook, Mr. Chikobi believes that it was incorrect to say that AMCON bought loans of 6 trillion naira. The sum of 6 trillion naira represents the face value of the loans outstanding at the time of intervention, but did not represent the amount that AMCON paid. The 6 trillion naira was made up of 1.7 trillion naira that AMCON paid for eligible loans, and 4.7 trillion naira represented the money that AMCON gave to the banks as financial accommodation to ensure that depositors were protected from the loss. The financial accommodation, according to him, was not AMCON's responsibility to recover, but that of the banking system through the sinking fund. Speaking further, Mr. Chikobi said, former Central Bank Governor Lamido Sanusi and I discussed mentioning the face value of the loans, and Sanusi prevailed that we should make the face value of the loans public in line with policy transparency and adherence to proper corporate governance standards. Sanusi felt this would give the loan resolution body greater flexibility in pursuit of recovery. According to him, if a borrower was in a hole for 1 billion naira, AMCON only to go for recovery of between 300 million naira and 400 million naira. But for former governor of the central bank, Mr. Lamido Sanusi, he felt that the agency should go for those loans and thereby putting a lesser burden on the system's sinking fund. Mr. Chikobi also noted that the highest recovery rate globally occurred in Malaysia, which was about 58%. We hope Nigeria can get to that level. AMCON's target was 70% asset loss recovery. So of the 1.7 trillion naira the agency paid for bank loans, its actual target was 70% of that, or what came to roughly 1.2 trillion naira. AMCON presently has recovered about 1.1 trillion naira according to the current chief executive, Mr. Ahmed Kuru. The 1.1 trillion naira recovery represents 92% of the debt resolutions company's target of 70% recovery of its 1.7 trillion naira paid to banks. Based on this number, Mr. Chikobi, the former MD of AMCON, said they may be correct in stating that the agency has done a good job of meeting its initial debt resolution mandate. His position may be at variance with the frustration of the agency's asset management partners, AMPs, who have expressed concern over the style and strategy of the agency in recovering delinquent debt. But premise on targets set by the Central Bank of Nigeria for the body, AMCON appears to have delivered on the original agency targets. An interestingly compelling point that Mr. Chikobi equally makes concerning the recently mentioned 5 trillion naira face value of AMCON debt is that no bank would sell for 40 kobo on every 100 kobo face value, an asset is strongly believed was worth at least 60 kobo on the naira. Interesting insights on the issues around the asset management company of Nigeria from this memo coming from Brochure. Very, very interesting insights on the role of AMCON, on the fact that we should not transfer that burden to taxpayers, and the issue of the bad loans. I think it's very important that we continue to engage and have these very intelligent memos and insights to bring regulators to book and also to notify them on some steps and how to adjust where necessary. Let's look at the European stocks and developments in the markets for the global markets. Of course, the European stocks has been very, very interesting this week. Just to update you, this week had been very busy for Europe. Global leaders had gathered and have agreed finally for $750 billion worth of recovery and stability fund in Europe. And President Emmanuel Macron and German Chancellor Angela Merkel were key drivers for that decision to be reached. And of course now it begins to bring some hope, some direction to European economic stability. With that fund, it should be able to go a long way to support all European member nations in terms of how they intend to navigate the COVID-19 pandemic and how they will want to move on in terms of addressing the challenges in the markets there. But just to note that for the pro-share memo on AMCON, we're not through yet. We'll come next week, we'll give you the way forward from the pro-share memo on how AMCON should structure itself. So watch out for that next week. But for European shares, it ended flat yesterday after a jump in the US weekly jobless claims, and the falling Eurozone consumer confidence put a dampener on the economic recovery hopes, erasing earlier gains made on the strong regional earning reports. The Pan-European Stoxx 600 index gave up gains of as much as 0.8% after data showed that the US jobless claims rose for the first time in nearly 4 months, suggesting the labor market was stalling amid a surge in COVID-19 cases. In Europe, consumer confidence deteriorated in July despite expectations of an improvement. According to analysts, the big question is how much pent-up demand will be seen in the months ahead. Sales figures in Europe have so far been encouraging, but the July confidence figures cast some doubts over the spending outlook, said Bert Collin, senior economist, Eurozone at ING. That is something that we'll be looking at in the course of the week. How will this impact the Eurozone and the European markets? Very important this period. As we begin to ramp up for this very interesting week of the market review, just to give you some updates, of course, we aware that the third mainland bridge, the longest bridge in the country, will be partially closed now for maintenance works and construction. And just getting this update from His Excellency, the Governor of Lagos State, Mr. Babajide Sanwo-Olu, says he wants to allay concerns that Lagosians may be having regarding the closure of the third mainland bridge, which is beginning this evening. The closure is necessary to prevent any disaster that may result from the total collapse of the infrastructure. The governor says that he wants to appeal to residents, that's Lagosians, to all of us in Lagos, to exercise patience during this period, as the Lagos State Traffic Management Agency last mile officers will constantly be on the road to ensure easy vehicular movement. The governor also says the traffic disruption is about 25% of the regular traffic on the bridge, so there should be no undue worries. 25% of the regular traffic, that's what he's saying. According to the governor, they have provided details of alternative routes so that residents can move to their homes or place of work easily. During the closure, a lane of the bridge will be open for vehicles driving inward Lagos Island in the morning, and the reverse will be done in the evening. Just take note of that. Well, in terms of personnel, the governor says they're deploying 650 last mile officers on the roads to control traffic. He urged all commuters to explore the option of the waterways, the jetty, built in a large area of Bariga and has been activated, and increasing the capacity of the ferry service. The governor says he remains committed to improving transportation in Lagos, ensuring Lagos has an efficiently run intermodal transportation system in an important component of the deliverables of his administration. That's the governor speaking on the closure of the third mainland bridge from this evening and how Lagosians should respond and navigate. We expect that this will be properly managed to ensure that Nigeria's economic capital continues to move on despite this action. This is taken for the next 6 months, and we hope it will be properly managed for the good of all Lagosians and Nigeria at large. That will be all for the market review. It has been an interesting week discussing the markets, analysis and reports and developments from the exchanges down to the capital market and how it impacts our economy. Join us as the conversation continues. You can log on to our website where we have rich content, watching our videos, news reports, and analysis on the financial and capital markets. This period, to all our investors and public, we want to once again advise you, beware of online platforms that promise 100 to 200% returns that are not registered or regulated by Securities and Exchange Commission. Do not give in to their schemes and strategies because that money you're saving is not worth losing to ill-advised investments. That'll be all for this edition once again. Thank you for watching. Have a lovely weekend and see you next week, but stay safe.